So when you talk about the gravity being back in the market, as Tom was saying, are there areas that are just not going to come back in the same kind of way? And I point to big tech, right? This question of whether we just witnessed the big expansion and deflation of a tech bubble that is not going to drive the economy in the same kind of way.
It's not a bubble. This is not like 2000. However, when you think about it, over the last 10 years, we've gotten to this point where the returns were driven by a handful of stocks, FANG Plus, whatever, which got to maxed out at almost 25% of the way to the S&P 500. What's likely going to happen is that, and you've seen it from time to time in components of FANG, they just go sideways while earnings catch up to valuation, and then they make the next leg higher. Long term, those are still secular growers. They're just not going to prop the market to the extent that they have.
And this raises a question about, again, the idea of risk-free rate actually being something, right? You actually have a real yield in a way, and people could argue over whether you actually do or not, but at least when you take a look at some of the metrics that are traditionally looked at, how much does that eliminate buybacks and some of the financial engineering that supported the stock market for so many years? How does that kind of bleed into valuations?
Well, it certainly, it's going to change the discourse between how companies allocate their capital, but you're still in an environment where the good companies in particular, and that has bifurcated to a greater extent this year, are throwing off tons and tons of cash. Buybacks are not going to disappear. It's just going to be a weapon that's probably going to be deployed more judiciously, let's say, in where you're actually going to return to a strategy of buying low and buying less high.